So hello everyone, and this is where we left off on part 1 of chapter 11, and we talked about the commercial paper market, which has come up as the Fed is trying to bolster the economy, right? And they're throwing money at the different markets, the money market mutual funds, which bolster the commercial paper market, and we talked about junk bonds. Okay, which are bonds from companies that are near default. That's why they call them junk, otherwise known as high yield bonds. Okay, so we're all aware of this whole virtual banking thing. We all bank online for the most part, I assume now, many of us anyway. All right, so the term securitization comes about, and this was a big reason for the '08 crash, is they took other assets that were rated poorly, subprime, and they were illiquid, and they securitized them into something that were rated AAA, and this is what caused all the problems. And basically, it was a big role in the subprime mortgage market. And I don't want it's it's early 2000s, right? Not mid 2000s. So they're normally called asset-backed securities. Speaking of money market mutual funds, I sent you an article on that. There's a discussion about this gentleman, Bruce Bent, and he basically almost took the whole markets down. You could do some research on him. And because of what he did, they're looking for ways to regulate this industry, okay, more heavily. There's a term that's often used. It's called loophole mining, and it's a way that companies can avoid existing regulations, okay. And basically, what companies do, banks do, is they look for any loophole they can find to avoid, regulations if they can. So there's an interesting curve here on slide 15, and this is from your book. And this is the bank share of total non-financial borrowing that has gone on in the last 57 years. And you can clearly see that banks are giving out less credit to non-financial companies over the years. And this is in the, you can get this whole thing in the Federal Reserve of St. Louis Fed here. It's an interesting article, but you can see by the graph how there's been a decline. Like in the 70s, there was a huge non-financial borrowing went on, and then it seems it's really tapered off. So there's other methods of borrowing that are going on now, probably through private investors. So basically, a lot of borrowing wasn't done because of the interest rates that rose, and there was other source of funds that were low cost. So there's a lot of reasons why the decline of traditional banking went on, and one of the big things is information technology, right? Computer-oriented technology, and basically the need for banks. Has to finance short-term credit has disappeared somewhat, and transaction costs for other financial institutions like insurance companies, which will loan you money. So basically, and increasing competition have gone on. So banks have pretty much responded by coming up with new innovative ways to make money and profits, and they're basically taking on more risk, and they're doing real estate loans, and they're getting involved with leverage buyouts, right, which is a lot of debt, and they're doing a lot more off balance sheet. Off balance sheet means they're doing a lot of financing and loaning that doesn't occur on the balance sheet, such as with derivatives. All right, so there's some good stuff here on the McFadden Act on how it restricted branching. So here's basically different nice table of FDIC insured banks and their size, as far as assets go. And you can see there's 9 banks that have more than $250 billion in assets here. But the majority of them are basically $100 million to $1 billion. The interesting part is these 9 banks. The interesting thing is these 9 banks here have over 50% of the assets. So, again, this is a good article here. If you you want to go there and read up in more detail on this type of stuff. So here's the 10 largest, nice table of the 10 largest U.S. banks. And obviously JP Morgan is here. Wells Fargo's been in the news a lot, right? They've got a lot of problems, Wells Fargo, as you can imagine. They've had a lot of problems, but this is the 10 largest banks. And you see TD Bank branches opening up all over the place. So there's been a lot of bank declines, a lot of consolidations, and a lot of bank failures. And again, there's always some kind of act that goes on, right? And there's a Regal-Neal Interstate Banking Act. So you can see the number of insured commercial banks has drastically dropped off. So you can see in 1935, there was roughly about 14,000 banks. And look at what happened by the third quarter of 2016. You can see the sharp decline in the number of commercial banks in the United States. So, basically the question is, what does banking look like in the future? And, they do a comparison with Europe and Japan as to what the system is going to look like, how it's going to be structured. All right, so I will do a part 3 and finish up. We're about 8 minutes into this now, so I'll do a part 3 and finish up. All right, I hope everybody's well. Talk to you later.